There's a term you're about to hear a lot more in the silver community in the next 8 business days. Insolvency point. A bank reaches its insolvency point when its liabilities exceed its assets. When depositors demand their money back and the bank cannot pay them all, that is insolvency. COMEX silver futures just crossed that line. Not legally, not officially, but mathematically. The arithmetic of paper claims versus deliverable metal has reached a level where the system is functionally insolvent if more than 32.7% of May contract holders demand physical delivery. And today, Monday, April 20th, 2026, with silver at $79.31, we are 8 business days from finding out if that threshold is crossed. Tonight, I'm going to show you exactly how we got here, why the insolvency point is real, what happens if it is breached, and why this is not a future risk, but a present crisis that is already playing out. Let me give you the exact numbers that define the insolvency point because this is not opinion, it is division. As of Monday, April 20th, 2026, COMEX registered silver, the metal officially available for futures delivery, stands at 76.88 million ounces. Total open interest across all silver futures contracts is approximately 575 million ounces. The coverage ratio is 13.36%, but the real danger is concentrated in the May 2026 contract. There are currently 47 of 34 open May contracts representing 235.2 million ounces of paper claims. That is 235.2 million ounces of legal delivery rights against 76.88 million ounces of actual metal. If exactly 32.7% of May holders demand delivery, the entire registered inventory is claimed. 0 remains for any other purpose. 32.7% is not a theoretical number. It is the precise mathematical threshold where the system runs out of metal. And here is why that number is not as safe as it sounds. Let me show you the historical delivery data that proves 32.7% is not extreme by recent standards. In January 2026, during the first full week of the month, COMEX experienced a physical withdrawal of 33.45 million ounces of silver in just 7 days. That was 26% of registered inventory at the time. The January contract had significant delivery demand and the vaults were drained to fulfill it. In March 2026, the March futures contract represented 528 million ounces of exposure against only 113 million ounces of registered silver at one point. The paper-to-physical ratio briefly hit 4.67 to 1 for that single contract month. The system survived March because enough traders rolled their positions forward instead of demanding delivery. But every contract month that passes without a delivery failure increases the probability that the next month is the one that breaks. The traders who rolled out of March did not disappear. They moved into May, and now May is sitting with 4734 open contracts, 8 days from first notice day, in a market where registered inventory has fallen another 2.3% in the last 30 days alone. The pressure is compounding, and the 32.7% threshold is within reach. Now, let me explain the 3 emergency mechanisms COMEX has to prevent a delivery failure and why each one is catastrophic for paper holders. Mechanism 1, emergency margin increases. On February 2nd, 2026, the CME Group raised initial margin for silver futures from 10% to 15%. The announcement came on a Sunday evening. When markets opened Monday, silver crashed from $121.67 to $71.22 in hours, a 41.6% collapse. Why did a margin hike cause that? Because futures trading operates on leverage. When you buy a silver futures contract, you do not pay the full value up front. You put up margin, which is a fraction of the contract value. When CME raises margin requirements, traders who are leveraged to the maximum suddenly do not have enough capital to maintain their positions. They are forced to sell. And when thousands of leveraged traders are forced to sell simultaneously, price collapses. CME can use this tool again. If delivery stress becomes acute in the final days before May 1st notice day, an emergency margin hike could wipe out 30 to 40% of silver's value overnight. That protects the exchange by reducing open interest, but it destroys anyone holding leveraged long positions. Mechanism 2. Position limits and trading halts. This is the nuclear option with historical precedent. On January 7, 1980, the COMEX Board of Governors invoked Silver Rule 7. This emergency rule prohibited the purchase of new silver futures contracts. You could only sell, not buy. The rule was aimed at the Hunt brothers, who were accumulating silver and taking delivery. Silver had reached $49.45 per ounce. After Silver Rule 7, the price collapsed to $10.80 by March 1980, a 78% crash in 2 months. Could COMEX do this again in 2026? Legally, yes. The exchange has broad authority to implement emergency measures to protect market integrity. If the May delivery demand threatens the solvency of major clearing members, COMEX could impose position limits, restrict new long entries, or even halt trading entirely until the stress resolves. Every one of these measures protects the exchange and the shorts. None protect the longs. If you are holding paper silver futures and COMEX invokes emergency rules, you could be forced to exit your position at a loss regardless of the fundamental supply situation. Mechanism 3. Cash settlement in lieu of physical delivery. The COMEX rulebook allows the exchange under emergency conditions to settle contracts in cash rather than metal. Instead of delivering 5,000 ounces of silver, the short holder pays the long holder the cash equivalent at the settlement price. This sounds reasonable until you realize what it actually means. If you bought a silver futures contract specifically because you want physical silver and the exchange tells you, sorry, no metal available, here is cash instead, you just got cheated out of the scarcity premium. The whole reason you wanted delivery was because physical silver is scarce. The cash settlement price does not reflect that scarcity because it is set by the paper market, which is the same market that just failed to deliver. In a genuine delivery failure scenario where physical silver is commanding premiums of $10, $15, or $20 over the paper price, cash settlement at the paper price is a massive transfer of wealth from longs to shorts. You get paid in inflated dollars for a scarce asset you can no longer obtain. Here's the London connection that almost no American analyst is explaining properly, because what happens at COMEX does not stay at COMEX. The London Bullion Market Association, known as the LBMA, is the world's largest over-the-counter silver market. More physical silver is traded in London annually than anywhere else. COMEX and LBMA are connected through arbitrage. When silver is cheaper on COMEX, traders buy COMEX futures, take delivery, and ship the metal to London to sell at the higher price. This arbitrage keeps the two markets roughly in sync. But it also means that stress in one market propagates to the other. In late 2025, the LBMA experienced a liquidity squeeze so severe that Silver Lease rates the cost to borrow silver for short-term delivery spiked to 39% annualized. Banks were paying 39% per year to borrow silver they needed to fulfill delivery obligations. The Silver Institute's 2026 World Silver Survey, published April 15th, explicitly states that physical silver availability in the London spot market may remain relatively tight in 2026. That is institutional understatement language for, we are concerned about another liquidity event. If COMEX May delivery stress forces large volumes of metal out of registered vaults, that metal is not available for LBMA arbitrage. London tightens, lease rates spike, and suddenly you have two interconnected markets both experiencing delivery stress simultaneously. That is when the paper price mechanism breaks entirely, and physical silver starts trading at massive premiums over futures. Let me give you the industrial user dimension that creates a feedback loop nobody is pricing in yet. Approximately 59% of silver demand is industrial. Solar panels, electronics, EVs, medical devices, water purification. These are not discretionary uses. These are supply chains that cannot function without silver. Industrial users typically hedge their silver exposure using COMEX futures. A solar panel manufacturer that needs 500,000 ounces of silver over the next 6 months will buy futures contracts to lock in the price. As long as the futures market and the physical market stay synchronized, this works perfectly. But if COMEX begins cash settling contracts instead of delivering metal, industrial hedges become worthless. The manufacturer bought futures to guarantee physical supply. Cash settlement does not give them physical supply. It gives them dollars, and dollars do not conduct electricity in a solar panel. In that scenario, industrial users panic buy physical silver on the spot market, not futures, physical. They need actual metal, and they need it immediately, and they will pay whatever premium is required. That spot buying drives the physical price further above the paper price. The divergence widens. More futures holders demand delivery instead of accepting cash settlement because they can see the physical premium growing. Delivery stress intensifies. The feedback loop accelerates. Here is the sovereign buyer angle that makes this delivery cycle different from every previous stress event. In 1980, the Hunt brothers were private individuals trying to corner silver. COMEX invoked Silver Rule 7, crushed their positions, and the crisis ended. The Hunts were forced to liquidate. The market stabilized. In 2026, the buyers driving physical demand are not private speculators. They are sovereign governments and state-aligned institutions. China imported 206.76 tons of silver in January and February alone, an 8-year high. Russia has been accumulating. BRICS-aligned central banks are systematically building hard asset reserves. You cannot invoke Silver Rule 7 against the People's Bank of China. You cannot force the Chinese government to liquidate positions the way you can force a private investor. Sovereign buyers operate on different timelines, different risk tolerances, and different strategic objectives than speculators. If sovereign demand is part of the May delivery equation, the COMEX has no mechanism to force those buyers out. They can raise margins all they want. China does not trade on margin. They buy outright. They take delivery. They hold. That is the structural difference that makes 2026 delivery stress potentially unsolvable using the tools that worked in 1980. Here is the ETF flow data that shows Western investors are waking up to the physical shortage just as the May deadline approaches. In 2025, global silver ETFs saw net inflows of 187 million ounces, according to the Silver Institute. That was a record year for silver ETF demand. The flows were driven by concerns about Federal Reserve independence, stagflation risks, and geopolitical instability. SLV, the largest silver ETF, holds physical silver in LBMA-approved vaults in London. When investors buy SLV shares, the fund has to purchase physical silver to back those shares. That physical buying draws on the same global inventory pool that COMEX delivery pulls from. Now here's the timing issue. The Silver Institute forecasts that coin and bar investment demand in 2026 will rise 18 to 20% to 227 million ounces, a 3-year high. That is Western retail investors finally entering the silver market in size after sitting out 2023 and 2024. This demand surge is happening simultaneously with the May delivery deadline. The 227 million ounces of projected coin and bar demand is separate from and additional to the 235.2 million ounces of May contract delivery claims. You're looking at 462 million ounces of combined demand hitting the market in the same quarter against a registered COMEX inventory of 76.88 million ounces and a projected 2026 supply deficit of 67 million ounces. The math does not work. Something has to give. Either prices rise dramatically to ration the available supply, or the delivery system breaks and forces a reset of the entire pricing mechanism. Here's the historical data on what happens to silver prices after a near-miss delivery crisis, because this pattern has repeated 3 times in the last 45 years. In 1980, after Silver Rule 7 was invoked and the Hunt brothers were crushed, silver crashed to $10.80, but within 18 months, it had recovered to $22. Within 5 years, it was back above $30. The delivery crisis forced a temporary collapse, but the structural scarcity that caused the crisis in the first place reasserted itself. In 2008, during the financial crisis, COMEX silver briefly faced delivery stress as counterparty fears surged. Silver fell to $8.88 in October 2008. By April 2011, it was $48.70, a 448% gain in 30 months. In 2020, when the pandemic created supply chain chaos, silver fell to $11.67 in March. By August 2020, it was $29.35. By February 2021, during the Reddit squeeze, it hit $30.35, and premiums on physical coins reached $15 over spot. Every single time the silver market has experienced delivery stress or near failure, the initial reaction is a sharp price drop as exchanges use emergency tools to suppress the crisis. But every single time, within 12 to 24 months, the structural scarcity reasserts itself and prices move dramatically higher. The pattern is consistent. The delivery crisis is the capitulation point, the bottom, the maximum fear moment, and the investors who buy at that moment capture the entire recovery. Here is what the next 8 days look like in practical terms for anyone holding paper or physical silver. If you hold May futures contracts and you want physical delivery, you need to notify your broker immediately. The process takes time, and if delivery demand is high, there will be administrative bottlenecks. If you hold May futures and you do not want delivery, you need to either close your position or roll to the July contract before first notice day. If you're still holding a long position on May 1st and you have not filed for delivery, you're automatically assigned to take delivery whether you want it or not. If you hold SLV or other silver ETFs, you are insulated from direct COMEX delivery mechanics, but watch the NAV premium or discount. If COMEX stress causes the paper price to disconnect from physical, SLV's net asset value could trade at a significant premium or discount to the spot price. That creates opportunity or risk, depending on which side you're on. If you hold physical silver coins or bars, you are holding the asset that the entire delivery crisis is being fought over. Every ounce of physical in your possession is one less ounce available to settle a COMEX contract. The more acute the delivery stress becomes, the higher the premium your physical commands over paper. 8 business days until May 1st notice day. 47,034 contracts open. 235.2 million ounces of claims. 76.88 million ounces available. A 3.06 to 1 ratio that has never existed at this scale in COMEX history. The May contract is not going to break the silver market because of a conspiracy. It is going to break because arithmetic does not care about emergency rules or margin hikes or cash settlement provisions. 3 claims for every ounce is mathematically unsustainable. The only question is whether the break happens this cycle or the next one, and whether you are positioned on the side that benefits when it does. This is the hidden AG. This is not financial advice. Do your own research, consult a licensed advisor, and understand that the next 8 days could rewrite how silver is priced for the next decade.